Guys, big week coming up. We got a lot of big companies reporting earnings, and we have the Fed meeting with a very possible rate hike coming into play here. We'll get more into that in just a few minutes. Guys, if you like our channel, I want you to do one of two things for me. I want you to like and subscribe to this channel, and also follow me on Twitter. I'm very active on Twitter. I talk daily, I tweet daily about economic ideas. I just love engaging in conversation about investing. So come check me out, follow me on Twitter. You're gonna love it. Mo, what is the probability of a Fed rate hike this week according to Chicago?
So if you go to the CME Fed Watch Tool website, it is a 98.6% chance that there's a hike coming this week.
98.6%.
Surprised me.
You know, there's been a lot of talk lately, Mo, that with inflation being a lot lower, people were expecting the Fed to really lighten up on things.
Yeah.
The pivot, right? However, Powell has been very, very clear lately that he wants to be more aggressive with inflation than less aggressive. And we've still seen major job growth and a lot of good, strong jobs data, which is an inflationary thing. And Fed Chairman Powell wants to fight that. Mm-hmm. So 98.6% chance, there's a 0.25% increase. There's like nothing written about a 0.5% increase.
No, nothing.
And 1.4% chance
of nothing.
And zero, they put nothing about a decrease in rates.
Right.
That's incredible.
Right.
What do you, Mo? So guys, if you remember, if you want to know something, the historical 10-year treasury is 4.4%. This is going back to like 1871. Mo, what's the 10-year treasury right now? I think it's like...
Let me pull it up.
Yeah, let's pull it up right now because, guys, the 10-year rate is a good way of looking at things. Now, you guys it's currently 3.83%.
Yep.
So right now, it's still over 0.5% lower than historical average. Now, it's 3.83%. What's the 2-year treasury, Mo?
2-year is at 4.86.
4.86. That's a 1% difference. That is an inverted yield curve. What does that mean when you hear that? The 2-year treasury is higher than the 10-year. Usually, in normal times, the 10-year the longer and longer you go out in interest, in a time frame, the more interest you get paid because there's more risk involved as you go out further. More likely that bad things happen, etc. Your money is tied up longer. You have more interest rate risk. The fact they're inverted tells us that people foresee the next 2 years to be riskier than the next 10 years.
And this has been inverted since July 6th of 2022.
Over a year
and I don't know
of inversion.
That in history
what that means is, I think history shows that there's always been a recession. I believe it's always been a recession.
It's always been a recession within 6 to 12 months of inversion.
Now, remember, recession is usually called after the fact or as you're through them. It's not like COVID or the great financial crisis where it was so quick because of some major event. So we don't know if we're in a recession. It doesn't feel like it. We have American Express just reported and said the consumer is strong. Consumer spending is 70% of GDP. 70%. Mm-hmm. So when they say consumer spending is strong, now granted, do they have a bias involved? Of course they do. But there's a lot of inversion. This is a very big spread. And by the way, this is one of the biggest spreads in history. That's the most interesting part. It's over 1% difference. That's a big difference in spread. Go ahead.
For this long.
And for this long, over a year.
That's the crazy
We're
part.
a year and 2 weeks now of inversion. That's a long time.
It's very long.
Now, I love having the 90-day treasury at 5.4%. I'm sitting on cash making 5.4%. Guys, that was 0% back in March of last year. 0%. Yeah. Not zero, literally. It was like 0.1%, essentially zero.
It went negative for a day.
That's right, it did, didn't it?
It was, so if you had your money in a 90-day treasury, you gave the government money.
Just to give it back to you at pennies less.
Correct.
That's an incredible idea.
Crazy.
So guys, that's a big piece of news this week. And remember, the market's going to go up and down. The economy's going to go up and down. If you're a believer in the US, then your goal will be to take these irrational movements in the market and try to make money off them. Hopefully, when stocks fall, you're able to buy great companies at much better prices. Much better prices. So for example, if you love Microsoft at 350, how do you feel about Microsoft at 200 if it were to happen, hypothetically? By the way, it wasn't far off from this back in October. You would absolutely die for it. And that's what we're trying to do here on the channel, is try to teach you the fundamentals and the process of investing. That way, when these things do happen, because they eventually will, you can jump on it and not be scared of it. Now, speaking of Microsoft, big companies report this week.
Yep.
Microsoft, Google, Meta, AT&T, 3M, Intel. Guys, I own a few of these companies.
A lot more.
So we're going to go do some earnings reactions to them. We love doing our earnings reactions. The reason being is they're a great way to look at the company because people love doing it. But remember, we still want to focus on the long term of the company. No company will beat on earnings and profit every single quarter. If they are, it's probably because they're lying. So we just like looking at these companies. A lot of companies. What did Domino's just report today? Domino's just reported. Didn't they? Did they beat?
Let me go and check real quick.
Because Domino's is like it's just one of those things where you sit. Oh, right here. Boom.
So Domino's estimated earnings was supposed to be $3.05, came in at $3.08.
So they beat on earnings.
Yep. Revenue estimate was $1.07 billion, came in at $1.02 billion.
So they missed by 4.5% on revenue. Okay.
And the stock price is up 1.4% now. Wasn't it down like 3%
It was.
earlier?
I don't know. Yeah, I think 3.3% before market, maybe.
Yeah.
All right, guys. These are the things we want to talk about. We want to sit there, but the main goal is focus on the long run. When you talk to me on Twitter, when you follow me on Twitter, you'll see that I sit there and say, okay, but what does this mean about the long run? Tesla just reported they're working with China to build build a $24,000 car. And I wrote in Twitter, I said, guys, when we do a Tesla video, all we repeat is they have to increase their average car price and sell the most cars in the world.
And now they're decreasing the prices.
And now they're decreasing the prices with incentives and going to a country where they have to build a $24,000 car.
$24,000 car and put the infrastructure in for the charging stations because
Everything.
I have a feeling that they're not abundant there.
And I just got a message, Paul, you're still not getting it on Tesla. It's not about fundamentals. It's not about valuation. It's about the good story and the potential in the future. What they don't realize is every investment is the present value of all future cash flow. What'd you say?
I agree with that for the short term.
Of course, short term.
You don't get the story. I get the story. I'm just not buying into the story.
So it's funny. We had a friend in town this weekend. You know what he said to me? He started talking about AI. He's like, I know you don't like AI. I go, I like AI. What makes you think I don't like AI? He's like, well, you're always bashing it. I'm like, no. What I'm saying is people overpay for AI.
AI's sweet.
AI's awesome.
I use ChatGPT every day.
Love it. And it's only going to get better.
Yeah.
But guys, is it possible to overpay for a good thing? Not only is it possible, it usually happens. Don't be that sucker. Be the person who understands that every investment is the present value of all the cash you're going to get in the future. And the more you pay for that cash, the less return you make. That's the key here. That's what we're trying to teach on this channel. We're trying to teach a process. We're not just trying to say to you, go buy this company. We're trying to teach you how to understand the companies and figure out a way using our software to understand how to value the company. That's the big key here. When it comes to economic data, guys, prognosticators I used to be that guy. I used to be the guy who says, oh, we're going to be in a recession. I stopped. Why? Because I'm just going to be wrong all the time. But what I've changed to is I stand here today and there's a lot of investment options. Now, one of my investment options is 90-day treasuries at 5.4%. My money can sit in cash, making me 5.4%.
With basically zero risk.
So then you have to ask yourself, what return do you need to get in stocks to justify getting that spread? Because before it was 0%. So people loved it saying, well, my S&P dividend is almost 2%, 1.6. I might as well invest in that. But now with cash at 5.4, what return do you need?
And there's a volatility there.
Oh, 100%.
That's the thing. Why would you go into a stock and try to make 5% when you have no volatility and basically no risk here for 5.4%?
It's considered the risk-free rate.
Yeah.
Now, guys, stay tuned with the channel because we're going to do a lot of earning reactions throughout the week. And you want to make sure that you get notified when that happens so you can watch our videos and get a better understanding every single day about investing. Thank you for your time.